Equity Market Update. Nifty and S&P BSE Sensex moved within a range during the month and ended the month with approximately 1% higher. Mid-cap and small-cap index marginally underperformed the large-cap benchmarks. Key events and factors included in-line budget with focus on capital spending, strong job and inflation data in the US pushing out rate cut expectations, significant upside surprise in India's Q3 FY24 GDP growth, among others. Most major sector indices ended the month with sequential gain except FMCG. Oil and gas, auto, power and healthcare were the key outperforming sectors. Global market performance was also strong, with most major markets ending with gains on month-on-month basis. FPIs bought equities worth $0.2 billion in February 2024, as opposed to net selling of $3.1 billion in January 2024. FPIs have bought equities worth $21.0 billion in 11 MFY24. DIIs, on the other hand, bought net equity worth $3.1 billion in February 2024 and have cumulatively bought equity worth $18.5 billion in 11 MFY24. Flows to mutual funds increased to approximately INR 35,700 crore in January 2024 compared to approximately INR 24,800 crores a month before. Cumulatively, mutual fund flows in equity-oriented schemes in 10 MFY24 stood at approximately INR 194,000 crores. In Q3 FY24 results, earnings of banks, NBFCs, IT, pharma and capital goods sectors were better than expected, while that of metals, oil and gas, utilities, consumer staples and durables were in line with expectations. Results of auto, logistics and chemicals were lower than expected. Outlook. As on February 29, 2024, Nifty 50 was trading at approximately 18x FY26E price-to-earnings multiple. Further, market cap to GDP stood approximately 106% based on CY25 GDP estimates, and the gap between 10Y GSEC yield and 1Y forward Nifty 50 earnings yield remains at elevated level. In general, current valuation indicators are at premium to their historical averages. However, one should view these valuations in the context of structurally attractive nominal GDP growth, a healthy corporate earnings outlook, and robust delevered corporate and banking balance sheets. Except for private banks, valuations for most major sectors are higher than long-term averages. The sharp broad-based rally in the current financial year has resulted in small-cap and mid-cap indices significantly outperforming, and they now trade at a noteworthy premium to their long-term average valuation. Given the aggregate valuation being higher than historical average, the importance of stock selection increases even more. We maintain a positive outlook on equities for the medium to long term, driven by the structurally robust domestic growth outlook, healthy corporate profitability, and supportive pro-growth policies. However, near-term risks include a significant global growth slowdown, heightened geopolitical tensions, and a resurgence of inflation either globally or domestically. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.